Hi, everyone. Thank you for joining me for another episode of EdgeBytes, where we strive to deliver signal over noise in the rapidly shifting landscape of enterprise tech. My name is Mark Vigoroso, founder and CEO of the Enterprise Edge. Today, I'd like to spend a few minutes sharing some perspectives on all the personnel moves that we've seen across major tech players since the start of 2026, just 6 weeks ago. So the facts tell us that the enterprise software is bleeding talent at an alarming rate. Look at Salesforce; they just cut nearly 1,000 jobs. Workday eliminated 400 more. Amazon slashed 16,000. And here's what nobody's talking about. This isn't about efficiency. I think it's really about survival. I've been in this industry for 3 decades, and what's happening right now, I don't think it's a correction. I think it's a pretty significant restructuring of the value chain. So let me share what I think is really going on. The numbers are the numbers. They tell a brutal story. According to TrueUp's tracker, so far this year, we've seen 88 tech layoffs affecting 36,000 people. That's 861 jobs lost every single day. Compare that to last year, 674 per day, and you see the acceleration. But the companies that are cutting jobs, they're not failing. Salesforce is launching new AI products. Oracle is raising $50 billion for cloud infrastructure expansion. IBM posted AI bookings exceeding $12.5 billion. These aren't distressed assets. They're profitable enterprises making strategic pivots. So what's the real story? In 2025, companies cited AI as the reason for nearly 55,000 layoffs in the US alone. That's 12 times more than 2 years earlier. And when Workday's CEO Carl Eschenbach stepped down on February 6th, just days after the company cut 400 jobs, or 2% of the workforce, following the 1,750 they cut a year ago at this time, you have to read between the lines. So here's the pattern I see emerging across enterprise software. Cut the overhead and double down on the product. So look at Salesforce. In September of 25, CEO Mark Benioff revealed they reduced their customer support workforce from 9,000 to 5,000. The company claims many were redeployed to sales and other functions, but Benioff explicitly said they needed fewer heads because AI agents handle support tasks. Now, in February of this year, they're cutting another 1,000 across marketing, data analytics, and their own Agentforce AI unit. They're simultaneously hiring for AI sales while eliminating the people who built their AI products. That tells you everything about where they see the value chain shifting. So look at Workday. It's even more revealing. They cut 1,750 jobs last year at this time, then another 400 this month, all in non-revenue generating roles in global customer operations. So what does this mean? This means the people who actually help customers use the product. Meanwhile, they're investing heavily in AI-driven HR tools that will theoretically reduce the need for those same support teams. So this is the new playbook. Automate the back office, invest in the front office, and hope that customers don't notice potential blips in service continuity. But honestly, I think what's actually driving this is not AI capability. It's more AI anxiety. A Bloomberg analyst said he's never seen a software sell-off like this, a $1 trillion tech wipeout in the enterprise software sector. Workday stock is down 34% from a year ago. Salesforce, ServiceNow, Adobe, SAP, all in basically free fall. But why? Because investors are terrified that AI platforms from OpenAI and Anthropic will make traditional SaaS obsolete. When Anthropic released Claude Cowork on January 12th of this year, the market reaction was savage. Gartner plunged 21%, S&P Global dropped 11%, Intuit and Equifax each lost over 10%. The JP Morgan Software Index fell 7% in a single day. The message from Wall Street is, we don't know if enterprise software will exist in 5 years. So companies are cutting costs to show margin expansion while they figure out their AI strategy. It's not about AI replacing workers today. It's about executives needing to demonstrate they have an answer to the AI question before their next earnings call. Here's the two truths I think we have to hold in our minds at the same time. Companies are using AI as both the justification for layoffs and the promise of future growth. Salesforce is cutting 1,000 jobs to hire new staff elsewhere for AI products. Workday is eliminating customer support to invest in AI. Oracle, according to analyst speculation, may be considering job cuts to free up, $8 to $10 billion for AI infrastructure, though the company hasn't confirmed this. They're all betting that the revenue from AI products will exceed the cost of rebuilding these teams later. But there's a massive assumption embedded in that bet, and that's that AI agents can actually deliver the same value as humans at scale, reliably across complex enterprise workflows. And we're not there yet. I think, in fact, we're still in the first inning, if you will, of the agentic AI era. An Oxford economics analyst put it pretty clearly when he said some companies are dressing up layoffs as a good news story by pointing to AI rather than pointing to past overhiring or current revenue pressures. The economist at Revelio Labs was even more direct. He said AI is a little bit of a front and an excuse. So what happens next? Three scenarios from most likely to least likely, right? First, I would call it the muddle through. Companies continue cutting support and operational roles while hiring for AI development. Customer service probably degrades, at least temporarily, but not catastrophically. AI tools improve incrementally. The transition happens over 3 to 5 years instead of 18 months. Stock prices stabilize once revenue growth proves AI isn't an existential threat. Second scenario, I'll call it the platform consolidation. A few large players, say Microsoft, Oracle, SAP, successfully integrate AI deeply enough to justify higher prices and market share expansion. Mid-tier SaaS providers get squeezed. They can't match the AI investment, can't compete on price, and can't differentiate on service anymore. So there's an M&A wave that follows. Third and final scenario, least likely, the disruption scenario, the bear case. OpenAI's Frontier, Anthropic's Claude, Cowork, and similar platforms actually do allow enterprises to build custom workflows without traditional SaaS vendors. Companies start churning off of Salesforce, Workday, ServiceNow. Revenue collapses, accelerate, mass consolidation, or exits. My read, I think we're really in scenario one, trending maybe towards scenario two. The mass layoffs we're seeing aren't proof that AI works. They're proof that CFOs are under pressure to show margin expansion while maintaining the narrative that they're investing in AI. So some thoughts, right? Takeaways. For professionals that are in enterprise tech, this is your signal, I think, to develop AI skills, yes, but more importantly, focus on customer-facing roles where relationship value is harder to automate. The industry is cutting the middle and betting on the extremes, high-value strategic work and low-cost automation. For executives, your customers are noticing the service cuts. You're making a high-stakes bet that self-service and AI agents can replace human expertise. If you're more wrong than right, your churn rate might tell you before your stock price does. The enterprise software industry is not dying, but the version that existed for the past 20 years, that's probably already gone. What replaces it depends on whether these companies can actually deliver on the AI promise or whether they just used it as a cover for old-fashioned cost cutting. So, as for me, I'm looking forward to the February 24th Workday earnings call. What management says about AI investment versus service delivery will likely be another signal regarding which of these three scenarios we're currently living in. So, that's all for today. Thanks for joining me on another episode of EdgeBytes. Tune in next time for more signal over noise. Take care, everybody.